Hi!
Hello guys, we are from Group 4 and today we are going to talk about merger and corporate restructuring. Let's start! Meaning of corporate restructuring. Corporate restructuring is defined as the process involved in changing the organization of a business. Corporate restructuring can involve making dramatic changes to a business by cutting out or merging departments. It implies rearranging the business for increased efficiency and profitability. In other words, it is a comprehensive process by which a company can consolidate its business operation and strengthen its position for achieving corporate objective synergies and continuing as competitive and successful entity. Corporate restructuring as a business strategy. Corporate restructuring is the process of significantly changing a company's business model, management team, or financial structure to address challenges and increase shareholder value. Restructuring may involve major layoff or bankruptcy, though restructuring is usually designed to minimize the impact on employees, if possible. Restructuring may involve the company's sale or a merger with another company. Companies use restructuring as a business strategy to ensure their long-term viability. Shareholders or creditors might force a restructuring if they observe the company's current business strategies as insufficient to prevent a loss on their investments. Need and scope of corporate restructuring. Corporate restructuring is concerned with arranging the business activities of the corporate as a whole so as to achieve certain predetermined objectives at corporate levels. Such objectives include the following: orderly redirection of the firm activities, deploying cash surplus from one business to finance profitable growth in another, exploiting interdependence among present or prospective businesses within the corporate portfolio, risk reduction, and development of core competencies. Corporate restructuring also aims at improving the competitive position of an individual business and maximizing its contribution to corporate objectives. It also aims at exploiting the strategic asset accumulated by a business, example, natural monopolies, goodwill, exclusivity through licensing, and etc., to enhance the competitive advantages. Thus, restructuring would help bring in an edge over competitors. Corporate restructuring aims at different things at different times for different companies, and the single common objective in every restructuring exercise is to eliminate the disadvantage and combine the advantages.
The various needs for undertaking a corporate restructuring exercise are as follows. The first one is to focus on core strength, operational synergy, and efficient allocation of managerial capabilities and infrastructure. The second one is consolidation and economies of scale by expansion and diversion to exploit extended domestic and global markets. The third one is to revival and rehabilitation of a sick unit by adjusting the losses with profits of a healthy company. The fourth one is to acquiring constant supply of raw materials and access to scientific research and technological developments. The fifth one is capital restructuring by appropriate mix of loan and equity funds to reduce the cost of servicing and improve return on capital employed. The last one is improve corporate performance to bring it at par with competitors by adopting the radical changes brought out by the information technology. The next part is planning, formulation, and execution of various restructuring strategies. Corporate restructuring strategies depends on the nature of business, type of diversification required, and result in profit maximization through pooling of resources in effective manner, utilization of other resources, effective management of competition, and etc. Planning the type of restructuring requires detailed business study, expected business demand, available resources, utilized or other portion of resources, competitor analysis, environmental impact, and etc. The bottom line is that the right restructuring strategies provides optimum synergy for the organization involved in restructuring process. It involves examination of various aspects before and after the restructuring process. To the next part is the important aspect to be considered while planning or implementing corporate restructuring strategies. The restructuring process requires various aspects to be considered before, during, and after this restructuring. They are: the first one is valuation and funding, second one legal and procedural issues, third one is taxation and stamp duty aspects, fourth one is accounting aspects, fifth one is competition aspect, and etc. And the last one is human and cultural synergies. Based on the analysis of various aspects, a right type of strategy is chosen. The next part is the types of corporate restructuring strategies. Various types of corporate restructuring strategies include merger, demerger, reverse mergers, disinvestment, takeovers, joint venture, strategic alliance, slump sale, and franchising strategic alliance. The next part is the example of corporate restructuring. ABC Limited has surplus fund, but it is not able to consider any viable projects, whereas XYZ Limited has identified viable projects but has no money to fund the cost of the project. The merger of ABC Limited and XYZ Limited is mutually beneficial option and would result in positive synergy of both of the companies.
Previously, we already discussed about corporate restructuring. So, merger, let's discuss it. So, what's the meaning of merger? Merger is the combination of two or more companies which can be merged together either by way of amalgamation or absorption. The combining of two or more companies is generally by offering the stockholders of one company securities in the acquiring company in exchange for the surrender of their stock. There are four commonly referred to types of business combination known as merger. The first one is horizontal merger. It is a merger of two or more companies that compete in the same industry. It's also a merger with the direct competitors and hence expands as the firm operations in the same industry. Horizontal mergers are designed to achieve economy of scales and results in reduce of number of competitors in the industry. The second one is vertical merger. It is a merger which place take upon the combination of two companies which are operating in the same industry but with a different stage of production or distribution system. Vertical mergers also provides a way for total integration to those firms which are striving for owning of all pieces of the production schedules together with the marketing network. The third one is co-generate merger. It is the type of mergers that two companies are in the same or related industry but do not offer the same products, but related products and may share similar distribution channels and providing synergies for the merger. This potential benefit from these mergers is high because these transactions offer opportunities to diversify around a common case of strategic resources. The fourth one is conglomerate merger. These mergers involve firms engaged in unrelated types of activities. The business of two companies are not related to each other horizontally or vertically. In a pure conglomerate, there are no important common factors between the companies in research, marketing, production, development, or technology. The purpose of mergers remains utilization of financial resources that enlarge debt capacity and also synergy of managerial function. We already hear about the meanings of mergers. We also already hear about the types of merger. So, what is a disadvantage and advantage of merger? Disadvantage of merger. The first one is reverse synergies which reduce the net value of the combined entity. For example, adjustments of pay scales, cost of servicing acquisition debt, defection of key acquired company staff. The second one is adverse financial effects because the anticipated benefits didn't materialize. For example, expected cost reduction were not forthcoming. The third one is antitrust action delaying or preventing the proposed merger. The fourth one is the problems caused by dissenting minority stockholders.
The advantage of merger. The first one is to increase the corporate power and improve the market shares and product lines. Second, aids in diversification such as reducing cyclical and operational effects. The third one is to help the company's ability to raise financing when it merges with another entity having significant liquid assets and low debt. The fourth one is to provide a good return on investment when the market value of the acquired business is significantly less than its replacement cost. Studies suggest that the shareholders of target firms that are acquired receive the greatest benefit. The last one is to improve the market price of stock in some cases, resulting in a higher PE ratio. For example, the stock of a larger company may be viewed as more marketable, secure, and stable. In evaluating a potential merger, you have to consider its possible effect upon the financial performance of the company, including the first one is earnings per share. The merger should result in a higher earnings or improved stability. In determining the value of earnings in a merger, you should take into account anticipated future earnings and projected PE ratio. A rapidly growing company is expected to have a higher PE multiple. The second, dividends per share. The dividends before and after the merger should be maintained to stabilize the market price of stock. Dividends are attractive to stockholders. However, the more company growth rate and earnings, the less is the impact of dividends on the market price of stock. On the other hand, if earnings are falling, the effect of dividends per share is greater. The third one is the market price of stock. The market price of stock should be higher or at least the same after the merger. The price of a security considers projected earnings and dividends. The value assigned to the company in the acquisition will most likely be greater than the present market price in the following instances. The first one is the business is in a depressed industry. The second is the acquired company is a greater value to the acquirer than to the stock market in general. And the last one is a higher market price than the current one is offered to induce existing stockholders to give up their shares. And the last one is the risk. The merged business should have the less financial and operating risk than before.